Greetings, Keith Prather here with another NCM RV demand update. So I'm showing, and I've got the index up. I think I've shared. I haven't shared yet. Sorry, let me share it real fast. So the index this month was kind of interesting because it showed that October came in at 121.8, up from September's rating of 121.7. And I want to just say two things here. Number one, there's a lot of reports out saying that RV demand and some of the interest and some of the inventory building activity continued a lot longer than normal. We'd call it unseasonal strength, kind of going deeper into the beginning of Q4, really. But the other thing is also remember that a lot of different sources reporting that, but government data is still behind, and some of the government data is a key input into the demand side of things. As we look forward and we try to forecast demand, that's kind of affected by obviously the government shutdown and lack of government data. There's a lot of data points that we use to really create these indexes that help us understand the sort of the underpinnings of the market, the consumer market, and how strong the consumer is and what they're interested in spending on. And so there's some estimates and forecasts and things here. I'm just saying this because we could see the index update and adjust once the government reopens. We get that data and we update the index. But for now, it was holding its strength kind of between September and October. Jogged sideways, we would call it, just 0.1% higher and about 2% higher year over year. And that's kind of an average growth rate. Most industries, and including the RV industry, if you were to say annually, I can give you 2 to 3% growth, we'd be pretty happy with that. That'd be pretty consistent. And we can work with that. But that's on the demand side of things. Again, this is a demand index looking about 6 months ahead. And so right now it's giving us a pretty good signal overall. The retail sales index maybe just slightly weaker on a month over month basis, down about 1.3%. Again, this data is dated. So once we get the government reopening and I get the PPI, it's the producer price index, we'll be able to update this. And I think you're going to get a different reading, but this is forecasted data. Now it's going up against a much weaker comp from last year. You can see it here. There was a little bit weaker, and so it's about 9% higher. I think that will adjust. We're not seeing sales that high when we look at independent data across industries. And as we talk to dealers, they're obviously not up that much year over year. Some categories doing better than others, but overall, at a broad level, not up this strong. So a couple of things that we're watching. We are watching consumers, and I've said it in some of the other videos. If you watched a few others, that when it comes to the consumer, the U.S. consumer is showing a lot of resilience. The U.S. consumer is depressed. They're scared. The sentiment levels are the weakest that they've been since really the Great Recession. And they're concerned about a host of things. They're concerned about things that we consider to be cyclical, and I'll talk about that in a minute. And they're worried about things that are systemic, and I'll cover that in a second as well. But our forecast through the end of the year shows consumer spending dipping a little bit, right? So it gets a little bit weaker between now and the end of the year, and then it picks back up. Now, we'll say this, that all year long, consumer spending, retail spending has beaten expectations. It's come in much stronger than expected. We saw retail sales with back to school up almost 5% year over year, which is a very strong signal. Even when we strip out the impact of inflation, we still saw retail sales come in a lot better, up around 2 to 3%, even after inflation adjustments. So we still have a strong consumer. We're seeing a little bit of spending on the discretionary side of things, the non-essentials, which RVs would fall into that category in most cases. But there's just a lot of things out there, obviously, that could create some headwinds. Again, sentiment is down. We're worried. I use the term fear factor a lot. There's a lot of fear factor out there right now in the marketplace, but there's also a lot of catalysts that could quickly flip that and turn it on its ear and make it a little bit better than what expectations are. Everything around the tax bill and some of the tax breaks that households would get. Performance in the stock market so far has been very strong for the year, and that helps. We also see maybe the ending of the government shutdown, a few trade deals. Some of the things could quickly swing sentiment. But again, there is some concern out there. And here's where most of it is coming from. And I wanted to show you this because I know when we look at RV sales, we've got roughly 22% of those sales that are in the boomer generation and retirees. And you've got the blend of the market kind of making up the balance of that. Some younger generation just getting into it with a lot of pull behinds. But then you've got sort of that cohort somewhere between the age of 36 and 65 that's out and about and going and buying motorhomes and just a lot of activity kind of in that category. Uh, but that category is also at some risk. Remember, I said a minute ago, I talked about some cyclical concerns and some systemic concerns. Cyclical concerns are things like poor economic activity, a little bit of weakness in just this economic cycle, and that can pull sentiment down as people are worried that they've got to go through this soft patch. The systemic kinds of things that we worry about are those things that make big changes that are not easily reversible. So, for instance, this AI job replacement, which I talked about this a month or two ago, we know right now we're counting on, and not counting on, but I mean, we're counting and we're estimating that we are going to lose about 4 million jobs to AI technology automation related changes. We know that's coming. We see the announcements right now. A lot of major brands are already forecasting that pullback. I mean, Amazon alone talk about, laying off maybe 600,000 workers between now and 2028 because they can replace them with robotics and automation and other things. And a lot of those, for the first time in generations, are going to hit some sectors that we thought were bulletproof, right? We thought that, computer programmers in the IT sector would always be in high demand because we just don't have enough programmers. At the same time, that computer demand would continue to increase. But the problem is that obviously AI now can replace them, can program so much faster. And so there's a job shifting that's taking place. And we're worried about the 4 million workers that we're going to lose over the next 36 months. We are going to create maybe a million jobs in high tech in the process. But that net loss of 3 million is something we're going to have to deal with over the next 36 months. It's going to push our unemployment indexes way above levels that we thought were normal. And there's just going to be a lot of uncertainty generated by this first wave. And again, it's systemic. It's because we're replacing people with a technology, and that makes it much harder to go create replacement jobs somewhere else in the economy. But then chasing it right behind that, okay, if we go out to about 2027 and from 2027 through the year 2030 and a little bit beyond, we're going to have more than 22 million baby boomers that are going to hit retirement age. It doesn't mean they're going to retire, but we're starting to see a greater incidence of many boomers going ahead and taking the wealth that they've created over time and taking early retirement, or regular standard retirement, if nothing else. So that 22 million workers is only going to be replaced by incoming about 2.3 million over that period of time. So we're seeing a net draw of about 19 million workers out of the workforce by 2030. Again, if these boomers go ahead and take retirement like they're expected to. So the net is that by the end of 2030, we're going to be short somewhere around 15 million workers. Over the same period of time, like for RV sales, I think this is critical. We're going to go through what is expected to be this great wealth transfer. And they're expecting over $12 trillion between now and the end of 2030 to be transferred from baby boomers that are passing away or trying to disperse their wealth to help with, avoid some probate taxes and things like that. Um, to the younger generation. So you've got Gen X, millennials, and Gen Zers that are of age and would be interested in purchasing big ticket items like RVs that are suddenly going to be hit with some of these windfalls of cash and the spending wherewithal. And whereas a house may be out of range for many of them, being able to purchase something that's fun, recreational, gets them out, feeds that experiential need that they have, that's going to be interesting, I think, as we move forward. And so watch for that to be a counterbalance that really kind of helps us blow through some of this period. A couple other things. We just talked about the boomer retirements, and we talked about that great wealth transfer, but also watch because right now the construction outlook is very positive in general. We see at least through next year non-residential construction, especially for industrial, which would include everything from data centers to power generation, even into traditional manufacturing, and then anything in distribution and warehousing, especially cold chain warehousing. Those big mega projects really driving a lot of demand. We're estimating, and what we see in the press right now is about $5 trillion in investments, outside investment and U.S. corporate investment in construction projects over the next 2 to 3 years. Just for comparison, just in the manufacturing sector, we're only doing about 223 billion a year. So you're talking about, on order of maybe 5 times the normal amount of spending working its way into the construction sector over the next 2 to 3 years. We're hearing general contractors right now that are actually starting to turn away jobs because their pipelines are full throughout 2026. So it's going to be very interesting, but the number of workers that are going to be finding opportunities in a completely different market, they're going to have a high paying job, but they're going to decide that, hey, I'm going to go live in an RV for the 19 months I'm going to be on site, and kind of travel back and forth, or I mean, whatever the case may be, go job to job, that increase is going to be positive and should help the industry out as well. Blue collar demand, excuse me, over this period of time is actually going to surge as well. Right now, a lot of those AI jobs, we are going to see a lot of job creation, again, in industrial distribution, warehousing. These are going to be higher paying jobs, especially those in construction. You're going to see good six-figure types of jobs being created. I saw a stat the other day that over the next 5 to 6 years, the greater number of millionaires being created in the United States will be in blue collar positions. That's interesting. And a lot of them are going to be finding this first time wealth. And so a lot of them will go out and make a lot of purchases that maybe some other categories of workers in the US have already done. So I think you're going to see a new buyer kind of entering the market. Last little thing I'll say just real fast, I am starting to see a lot of similarities between the RV industry and what we're seeing in the maritime industry, where younger generations are inheriting assets from older generations as they pass away or if they move on to a different stage in life. But those assets that they're inheriting aren't exactly what they want. And so they're taking that asset and its trade-in value, and they're taking some of the additional wealth that they're getting, and they're going in and they're upgrading that asset. So if it's an RV, it's some of the older technologies, and they're taking that, trading it in, and they're moving up into a new unit, that has some of the amenities that they're looking for. And so I think that'll be a trend that we see across a number of different big ticket sectors, but that's something to watch. So overall for the economy, not as much a big impact for RV industry. I think there are other drivers in the economy that'll help. But overall, we see an economy that looks like it's going to be pretty stable. I will say this, that this industry, you'll see it in the briefing if you read the briefing, it's a very interest rate driven. And 80% of the purchases, brand new purchases, are made using borrowed funds, and that it is interest rate sensitive. About 83%, well, there's an 83% correlation between interest rates and actual RV sales. And we're at a point now after this last Fed funds rate cut of 25 basis points, right? It brings this year to 50 points. We believe between now and the middle of Q1, we're going to get another 50 basis points, especially if those labor layoffs accelerate a little bit. And so with that in place, what you should see is what we consider to be a stimulative economy for RV sales. And so you would expect that sometime by Q2, Q3, not only do you have seasonal factors kicking in, but some of these other factors will start to kick in. People will have realized their tax benefits. We should see mortgage rates come down, should see a lot of refinancing of mortgage rates, which could free up $150 to $250 a month in discretionary spending for the average American. So you got a lot of factors that look like they're going to create some opportunities. Just at this point, it's what we call hopium, right? We're hoping that it comes. It looks like the mechanisms are in place, but we don't see it yet. And we're hoping that other factors don't overwhelm some of the positive stimulus and kind of pull us down. Um, so that's what I had for you this month. Again, we'll get a lot of brand new government data as the government reopens and as we kind of get through November. I'm hoping that after the holidays, when we do the next update, that you're going to see everything updated, and you're going to be able to see some different trends and some a lot of confidence in what those trends are. And that's our goal, hopefully by the time you come back from the Thanksgiving holidays. So anyway, hope everyone is very safe with your holiday travels, and hope you have a great one. And we'll see you on the other side. All right. Take care. Bye bye.